Good morning, everybody. What's going on? It's Kris here. I want to do a quick video because I got a phone call this morning and they happen pretty often, and I want to make sure I just sort of talk through it. Why do I hate doing manufactured home loans for anything that's pre-1976? I've done a bunch of videos on here. I do get calls very often on homes that are older than 1976. And I almost always end up having the same discussion, whether it's a real estate agent, which is who called this morning, or if it's somebody that's looking to buy a house. So let's talk about why people typically look at a home that's pre-1976. Almost always it's because it's a very cheap house. It's really two things. It's always because it's cheap. Always, always, always. I'm going to explain to you why it's cheap. But the second one is for some reason, a lot of these pre-1976 homes were bought by somebody, usually an investor, or it was somebody that's looking to sell it that saw that there was a struggle to sell it, and then they renovated the home. So I get a phone call, and it's like, I found this turnkey house, and I want to get a loan for it. It's pre-1976, or I hear, really, it's the price that usually throws it off for me. Of course, we do loans in multiple states, but I'm going to physically talk about California because I think you can see the disparity pretty clearly when we talk about California manufactured homes. So if it's a manufactured home, 1976 or newer, so a manufactured home, and it's on owned land and it's permanently affixed, it's considered real property. So it has a permanent foundation. In the state, let's just say Southern California, those homes typically start at about $400,000 and work their way up. I've seen them over $1 million. Now let's talk about a manufactured home, not on permanent foundation, land owned, or it's in a park on permanent or not permanent foundation, but it has some type of land that's leased. Okay, well now we're talking about a chattel loan. So the first one we talked about, those are FHA, VA, USDA. Second one is going to be land lease, but it's 1976 or newer, so it's still considered a manufactured home. That's going to be a chattel loan. Chattel loans are pretty good loans. They're fantastic loans, but typically now we're looking about the price points. Price points are going to be about $100,000 up to $400,000. I've seen them go up to $600,000 if they're on the beach, Southern California. Okay, but it's a different type of a loan. Interest rate is going to be 1-2 percentage points over the going rate, and there's going to be a 5% down payment. The closing costs can be rolled into the loan. But now let's talk about pre-1976. A pre-1976 home is considered a mobile home. It is not a manufactured home. I've done a ton of videos on 1976 homes, but this is the key. The key is that it is a depreciating asset, meaning it never goes up in value. Whatever you buy it for, it's going to lose money. That's the way the bank views it. It is going to be worth less tomorrow than it is today. So when you ask the bank, hey, I found this house, I want to borrow money from you in order to buy it, I tell people the bank only cares about two things. The bank cares about protecting its asset and making a profit. That's the bank's job. That's whether you're buying, and people start getting really wrapped around the axle like, whoa, house, that's greedy. No, this is for everything. If your refrigerator stops working today and you go to Lowe's or Home Depot and you need to borrow money to buy that refrigerator, somebody's letting you borrow that money. They're not giving it to you for free. And I've had people really jump on this train of, well, that just seems mean. Okay, it is. But do you have the money to buy a new refrigerator? If the answer is no, and you need to borrow money from somebody, why should somebody give you money for free? They're investing their money because they have it, so you can borrow it and they get a return on that money. That's how home loans work. That's how that's how car loans work. Anything that you're going to borrow money for, that is the basic principle of borrowing money. But the big one when it comes to a house is they want to protect their asset. Here's why. When you start talking about hundreds of thousands of dollars, the bank wants to make sure that if you default on the loan, meaning you decide that for one reason or another, tough times come, whatever it might be, but you stop paying on that mortgage, that they're able to get that asset back and sell that asset to get their money back. They want to get their money back. They gave it to you, trusting you. You defaulted. They want their money back, right? And that's part of still controlling it. It's no different than your car, right? So again, going back to, I hear, well, that's mean. Look, if you stop paying on your car, they repossess it. It's no different. Now they're repossessing your house. It's the same thing because you chose to borrow money, then you chose not to fulfill your obligation Therefore, they want it back so they can get their money back that they let you borrow. So when you talk about something that doesn't stay at the same value, if I borrow $100,000, the house is worth $100,000. The bank lets you borrow $100,000. They want $100,000. If it's an appreciating asset, then the bank knows that if you default, they're going to get their money back at a minimum. If they think that it's not depreciating, this is where we get into the down payment scenarios. Every type of loan has a different variation of a down payment. That down payment is to offset that in between, and then they have the mortgage insurance if it's not at 20% equity. So if there's a variation in the market, they're still going to get their money back. So when you start talking about very ugly loans or a depreciating asset, they're going to ask for a significant amount of money up front, typically about 35%. So if you find a house that's $100,000 in Southern California or less, usually less, that is typically older than 1976. And it's considered a depreciating asset, meaning if you bought it for $90,000, it will not be worth $90,000 next month, according to the bank. It's going to be worth less, just like a car. When you buy a car, it's a depreciating asset, right? So they're going to ask for more money down, but this is the big one. The interest rates are high. I've seen them go, 15% or more. So it's just like going down to, so I was in the Marine Corps. If you're in the military, you'll get this. Almost any military base, you can go outside of the gate at that base and you're going to see a used car lot. Look at this really cool Mustang. It's got 800,000 miles on it. It doesn't matter what your credit is. No credit, no problem. Come over here. We're going to buy it to you. What they do is they jack up those interest rates and they ask for a pretty heavy down payment to hedge their bets, knowing that if you default, because the odds are good you will, because you can't afford to go out and buy a normal car, then they're just going to repossess it. And unfortunately, that's what a lot of banks look at, the couple of banks that do those loans. And I personally feel that they're predatory loans. I'm not saying they are, they're legal loans. My ethics, for me personally, I think they're ugly loans. Therefore, I typically, case by case, I will do those loans, but I typically won't do them because I feel like if you aren't in a position to where you can comfortably buy a house appropriately, you probably shouldn't be able to buy a house. Now, I'm not saying that you can't. I'm not saying that you won't. I'm not saying I won't fund it. It's just, for me, ethically, if I feel it's a very ugly loan, it makes me feel ill, and I personally don't want to fund that loan. So I would always, which I always do, if somebody calls me, I say, on this particular house, I don't want to do the loan. However, I have somebody that will fund it. And I do. I pass that loan to somebody that will take care of that client, take care of that agent. It's just, I personally think that they're very ugly loans and they make me not feel good about myself. So that's what I want to talk about today. Pre-1976 homes, manufactured homes specifically, which are mobile homes. And if you have any questions, hit me up. I always put my phone number and information in the comments below. All right. Have a good one. Talk to you all later.